What if I told you that one of the most powerful wealth-building setups of the year just played out in real time, and the vast majority of investors completely missed it? What if the very thing that was supposed to destroy a company, a full-scale legal war with one of the most dominant pharmaceutical giants on the planet, actually ended up being the trigger for a 40% explosion that blindsided nearly every analyst covering this stock on Wall Street? What if we told you back in February that this was coming and the data supported every single word of it? Here on Smart Stock Sam, we do not chase noise. We follow the data, we track the institutions, and we find the asymmetric setups before the crowd even knows they exist. Today, we are breaking down exactly what just happened with Hims & Hers Health, how a stock that was being treated like a sinking ship just delivered a generational return, why the bears who were celebrating days ago are now completely and dangerously trapped, and most critically, how much higher this thing could realistically go from here. We are talking fair value models, options flow, short squeeze mechanics, detailed price targets, and the one hidden business segment that most people simply are not paying attention to. Stay with me the entire way through, because if you think the 40% move is the complete story, you have not even scratched the surface of what is actually unfolding here. To fully understand the magnitude of what just happened, we have to go back to February 26th. That is when we put out our original thesis on this channel, calling Hims a generational buy. At the time, that was not a popular call. The sentiment around this stock was genuinely toxic. Analysts were cutting price targets left and right. Institutional holders were quietly reducing their exposure in the background. The stock was being treated as if the business itself was fundamentally broken, when in reality, the underlying business was anything but broken. The bear case was loud and deceptively simple. Hims was selling compounded GLP-1 medications. Novo Nordisk was furious about it, and the consensus assumption was that a prolonged legal battle would either drain the company's resources entirely or force them to abandon their highest growth product line. That was the fear dominating every conversation. And fear, as we always say on this channel, creates the very best buying opportunities on earth. But here is the question you have to sit with. What are the realistic odds that a company generating $2.35 billion in annual revenue, posting positive net income, and producing $300 million in operating cash flow just quietly disappears? What are the actual chances that Wall Street was right to price this stock as if the entire business model was standing on the absolute edge of a cliff? The answer arrived on March 6th, and it arrived with extraordinary force. The legal overhang that had been suffocating this stock for months did not end in a courtroom defeat. It ended in a landmark strategic partnership. Hims and Novo Nordisk, the two sides of what looked like an unresolvable pharmaceutical conflict, reached a truce, and not just any truce. Hims will now sell branded Wegovy and Ozempic directly through their platform. Take a moment to really absorb what that means. The company that was being actively sued for competing against Novo Nordisk's flagship products is now an authorized distribution partner for those exact same products. The bear thesis did not just weaken, it was completely and utterly dismantled in a single night. The existential legal risk that everyone had been pricing into this stock for months has been converted directly into a recurring revenue stream. And the market reacted exactly the way you would expect when a fundamentally sound business has been dramatically mispriced by manufactured fear. Friday's close came in at $15.74. Then the news dropped after hours, and the stock exploded all the way to $22.11 in a single session. That is a 40% value unlock that most people said could never happen this fast. Now here is the critical mistake most retail investors will make. They will look at that move and assume the opportunity is already behind them. They will say the stock already ran, the trade is over, and the easy money is gone. But that thinking completely ignores the fundamental reality sitting underneath this price action. This was not a meme stock pump. This was not a short-term earnings beat. This was the market finally correcting a valuation that had been crushed by manufactured fear and institutional forced selling. The move to $22.11 is not the ceiling. For many serious analysts, it is barely the starting line. Let us dig into exactly why the fundamentals justify a dramatically higher price. In 2025, Hims generated $2.35 billion in revenue. But what truly separates this company from the typical high-growth tech play is that they are generating real, sustainable profit. $128 million in net income, $300 million in cash from operations. This is not a company burning through investor capital to keep the lights on. This is a self-sustaining profitability engine with the balance sheet flexibility to pivot, partner, and expand without needing to return to Wall Street with its handout. So given a business this strong, what is it actually worth? This is where the numbers become genuinely staggering. According to discounted cash flow modeling from Simply Wall Street, the fair value estimate sits at $64.81 per share. At $22, the stock remains roughly 74.6% below that fair value target. In a bull case scenario, one where Hims fully captures the longevity and preventative health market expanding at historic speed, fair value stretches all the way to $86.09. Consider that carefully. After a 40% surge that shocked most of Wall Street, this company is still trading at less than a third of its estimated intrinsic value. The question is no longer whether meaningful upside remains. The question is whether you have the patience and conviction to hold long enough to fully capture it. But here is the piece of this thesis that almost nobody is covering, and it may be the single most important data point in the entire story. Everyone is fixated on GLP-1s. Ozempic, Wegovy, compounded semaglutide. But there is an entirely separate division of this business that, valued on a standalone basis, is worth more than the company's entire pre-surge market capitalization. The women's health segment, the Hers business, has reached a $1 billion annual recurring revenue run rate. Analysts estimate that division alone is worth $5 billion. That is nearly 1.5 times what the entire company was worth before Friday's announcement. At current prices, you are effectively acquiring the entire men's health platform, the Novo Nordisk distribution partnership, the compounding infrastructure, and all of the long-term upside for essentially free. Is there any realistic scenario where a company with that structure continues to trade at a massive discount to just one of its own divisions? Now let us talk about the institutional shakeout, because understanding this dynamic is critical to understanding why the setup was so explosive. In late February, major players were trimming exposure aggressively. JP Morgan cut their stake from 8.1% all the way down to 1.7% by February 27th. Analysts at Barclays and TD Cowen were lowering price targets as recently as March 5th. One single day before the 40% explosion. These were the players selling at the exact bottom before the entire narrative flipped. This is a pattern we track on SmartStock-SAM. Institutional forced selling creates the deepest mispricings in the market, and those mispricings produce the most violent recoveries. The lesson is not that institutions are always wrong. The lesson is that their selling is often mechanical, and when concentrated at technical lows with deteriorating sentiment, it marks the precise moment the most explosive setups come alive. Now, we arrive at the fuel that is going to power the next leg of this move. The short interest on Hims immediately before the news drop was 38.94% of the float. Let that number sink in for a second. Nearly 4 out of every 10 shares available to trade were being borrowed and sold short by people betting this company was headed towards zero. The short volume ratio on Friday alone was 45.47%. With 4.0 days to cover, there are millions of shares that must be repurchased regardless of where the price moves next. These are not voluntary buyers making calm, rational decisions. These are trapped shorts facing mounting losses on every single dollar this stock moves higher. Could the combination of short covering pressure, the formal Novo Nordisk partnership announcement, cascading analyst target upgrades, and fresh retail momentum produce another violent move that catches the bears completely off guard a second time? Could we see a gamma squeeze layer on top of the short squeeze that sends this stock through multiple resistance levels in a single session? That is exactly the scenario the options market was quietly pricing in before the news ever dropped. Massive volume was building on the March 13th expiry at the $10 and $15 call strikes, with over 10,000 contracts at the $10 strike alone. Thousands of traders are deep in the money as of Monday's open, and the elevated activity at the $17 and $18 strikes tells us that sophisticated participants were already systematically repricing the floor for this stock well before Friday's close. For the trading week ahead, here are the key levels every Smart Stock Sam viewer should have on their screen Monday morning. Primary support holds at $15.74, the Friday closing price that represented the last line of defense before the news broke. Secondary support sits around $18.88, which was the base established during the initial after-hours reaction. On the upside, the first real resistance zone is the after-hours peak of $22.11. A clean hold above $20 on meaningful volume is the signal that confirms the new floor is established and that institutional buyers are stepping in, not just short covering. Clear that first resistance level and the near-term target becomes $25 as analyst upgrades begin flowing in from firms that had been sitting on bearish targets. Mid-term consensus from firms like Canaccord points toward $30 to $32. And the 2030 projection models show $6.5 billion in revenue and $1.3 billion in EBITDA, implying a potential return profile of 6 to 12 times from current prices. This is not a trade. This is a multi-year business transformation that is only just beginning to be properly priced by the market. Before we close out, something important must be stated clearly. Nothing in this video constitutes financial advice. I am not a licensed financial advisor, and everything discussed here is strictly for educational and entertainment purposes only. Always conduct your own independent research, understand your personal risk tolerance, and consult a qualified financial professional before making any investment decisions. Investing in individual equities carries substantial risk, and past performance is never a guarantee of future results. Markets can and do move against even the most well-constructed theses, and risk management matters as much as the analysis itself. Here is the final verdict. What we just witnessed was the definitive end of the revenue mirage narrative that had been used to suppress this stock for months. A company priced for catastrophe revealed itself as one of the most structurally sound digital health businesses in the market today. The bears did not just lose the argument, they got completely trapped inside it. The Novo Nordisk partnership did not simply remove the legal overhang, it transformed the entire competitive positioning of this company overnight. And the HERS segment continues to sit quietly as a $5 billion standalone asset that the broader market has barely begun to price correctly. The generational buy thesis has been validated. So here is my question for you, and I genuinely want your analysis below. Do you believe HIMS can hold above $20 as a sustainable new price floor by the end of this week, or do you see a retest of key support before the next leg begins? Drop your level breakdown in the comments right now, because the conversation in this community is as valuable as the research itself. If this breakdown delivered real value to you today, hit that like button and do contribute towards making this video rank in Hype Leaderboard. It makes a genuine difference in helping Smart Stock Sam reach more data-driven investors who deserve to have this information. And if you are not yet subscribed, subscribe today, because the next asymmetric setup is already forming, and you do not want to be the last one in the room when it triggers.